Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, John Briggs and Joann Spadigam.
So we're recording this fresh from the Bank of England decision this morning. So let's start with you, Imogen. What did we learn from today's decision?
Yeah, I think you would describe today's decision as a dovish hold. So they kept rates unchanged at 5.25, as was very much expected. But there were a few dovish elements. First of all, the vote. So there was an additional dissenting vote for a rate cut from Sir Dave Ramsden. So we had a vote split of 7-2 versus last meeting's 8-1. I think from what I could sense, sell-side analysts were kind of 50-50 split on whether we were going to get that additional dovish dissent. We were in the 8-1 camp, but nonetheless, that gave it a kind of incrementally more dovish feel. Of course, the projections were quite dovish, as we had expected and talked about on this pod last week. At the 3-year horizon, on the market implied path of inflation, the BOE projected CPI to be 1.6%, so down from 1.9 in February, which implicitly is kind of, telling us that the market is pricing in too hawkish a reaction function. But then Bailey in the press conference actually went one step further than that, and quite explicitly said, if everything pans out according to their projections, which obviously there is a high degree of uncertainty around that, but if everything were to pan out as in line with their expectations, they do think that they will need to cut rates more than the market is currently pricing. There was also a kind of incrementally more dovish feeling, I think, to the paragraph in the minutes which discussed the views of the majority. So the 7 voters that voted for unchanged rates. It talked in the minutes about this spread of views about when the timing might be right to cut rates, and what data they will be looking out for, or how much of that data they might need to see before voting for a rate cut. And that's important, I think, in the context of the change in the vote split this time around, because with 2 members now voting for rate cuts, of a 9-member committee, it's quick maths to think that you only need 3 more members to dissent in favor of a rate cut to kind of get there. So all in, I think it's an incrementally more dovish meeting that gets you a little bit closer to a rate cut. But especially, I think watching the subsequent market reaction was perhaps not enough to out-dove the market.
I'm just thinking about your rates views. Has this meeting changed anything there?
Not especially so. I think at the margin, this kind of incremental dovish shift and this idea that, you only need to get 3 more members now looking for a rate cut, and there was a clear spread of views amongst that majority 7, perhaps makes June a little bit more likely than we were previously expecting. But regular listeners to the pod will know that our base case has long been August, and kind of until today, we thought that June was maybe only 25% likely. Now perhaps we're closer to maybe 35%, but not meaningfully so. And like I say, I think the market reaction was quite telling in that although this was a dovish meeting, a dovish hold, we actually didn't really get an especially dovish market reaction at all. And actually at the time of recording, around 3 p.m. on Thursday, markets are actually pretty much unchanged from their pre kind of 12 p.m. levels. And I think that shows that those that were looking for a June cut, which was almost 50-50 priced heading into the meeting, were probably looking for a clearer signal than what was actually given by Governor Bailey. He was very clear that June was live, but he gave no suggestion either way of which way that vote would go. And I think if you were looking for a June cut, you would want a clearer signal that was, the way that the direction of travel of the committee. So it doesn't really change our overall view that August will still be the right time for the first rate cut. That's driven by the fact that you'll, sounds obvious, but you'll have a little bit more data in August than you will in June. Of course, by June, they will have the key April wage data, but that data is subject to quite large revisions on the labour market side. And so by August, you will have had another month of the data, but also the revisions for April. It's, of course, a monetary policy report meeting, which gives them a bit more of a justification, I suppose, for a policy shift, and it gives them a backdrop of a more thorough analysis of the data since the previous monetary policy meeting to allow them to cut rates. From a market view, though, I still think that what the market is mispricing is not necessarily the timing of the cuts, but the scale of easing beyond that first cut. And like I say, I think Governor Bailey today gave the clearest signal that they have given for some time, especially given that they tend to avoid trying to comment on market pricing, that the market is kind of underpricing the sort of extent of the policy pivot in the second half of the year. And I think that's where we could see the biggest correction as we near that June date. And then the first cut in August, I think you will see the market start to price in a deeper cutting cycle in the second half of this year.
So away from rate cuts, we also discussed last week that you'll be looking out for any comments on QT. Was there anything new on that front from today's meeting?
Not a huge amount, in the sense that there was nothing in the formal guidance as we were expecting, and there was just one question on this in the presser, which was really around, as we discussed last week, the kind of rising take up in the Bank of England's short-term repo facility, which was created before they began QT, quantitative tightening, to ensure that there was still sufficient reserves being supplied to the system once they eventually reach this kind of steady state equilibrium level of reserves, which they, by their own admission, don't really know where it is. So there had been, and certainly we had contributed to that discussion, there had been sort of growing discussion around the fact that actually maybe a rising take up in the short-term repo facility was indicative of the fact that we were nearing this kind of steady state level of reserves, and that would increase the likelihood that active sales, so the kind of part of the QT program where they sell bonds back to the market rather than just letting them roll off the balance sheet, could end in September. In actual fact, Ramsden sounded fairly relaxed, I think, around the drivers of the take up in that short-term repo facility. He talked about it being down to things like month end. He talked about the fact that there was a big gilt redemption. He talked about the fact that it was driven by the syndication that we had a couple of weeks ago, driven by movements in FX swaps and all those sorts of things. And he also said that we are still very far from the point at which they think is the kind of equilibrium level of reserves, both of which are true. But I think it's interesting the fact that Ramsden highlighted quite temporary factors, which really are all now behind us. We're 9 days away from month end. The syndication was a couple of weeks ago. The redemption was a couple of weeks ago. And yet, even today, we had another announcement from the BOE that take up in the short-term repo facility has reached another record high and is still rising. So, I'm not suggesting that it's flashing a really red warning sign about the level of reserves in the system, but I do think that it is probably a little bit more about that than Ramsden perhaps gave credit for today. And his other point around, still being quite far from the steady state level of reserves is not inconsistent with what we've heard from the Bank of England before. Bailey has previously talked about this steady state level maybe being in the region of 500 billion, and reserves today are, over 700 billion in the UK on the Bank of England's balance sheet. So yes, we are still quite far from where they estimate that level of reserves should be. But of course, the combination of QT and the roll-off of the Bank of England's TFSME, their lending program, means that it doesn't take very long before we actually get to that 500 billion. And therefore, although they might not be thinking about it today, perhaps come September when they have to, opine or vote on what the pace of QT will be for the 12 months ahead, it might be a bigger feature of their discussion. So it didn't really, although Ramsden did sound quite relaxed about QT, it hasn't changed our view that actually we do think that active sales could end in September, especially given the fact that the natural roll-off of their gilt holdings is very high in the 12 months from September. And so unless they were to increase the pace of QT significantly, which I don't think is really on the table, actually whether they end active sales or not from a market's perspective isn't all that important, because it doesn't change the kind of overall net supply picture, which long-time listeners will know is a driver for us having this still quite elevated yield forecast, even in a monetary policy easing environment and an easier monetary policy environment than what the market is currently pricing. Anyway, that's probably enough on the BOE. So let's switch gears and talk about the Fed. John, thank you for joining us this week, because last week we had Kevin on the pod and he ran through the updated Fed call where we, now expect less easing than we were, and for that, or less easing in 2024 than we did, and obviously for that easing to begin much later in December. How has that impacted your view of US rates in general?
Well, just like we've moved to higher for longer on the policy side of things, in tune, we've moved to higher for longer on the rate side of things. You and I have talked in the last few weeks about this perspective that, inflation can determine perhaps when the Fed cuts, and then growth by how much. And as Kevin told you last week, that lack of progress on the inflation side of things has pushed that off. The other thing that we've thought about is this idea of level versus time. The levels could be attractive, even objectively, with these higher yield levels, although we're off the high yields, but we've seen in the last few weeks pretty attractive. And we have seen some, medium-term, longer-term investors putting some money to work, especially in the front end. But, in a negative carry environment, if you're looking out towards rate cuts as we are towards the end of the year, you still have time working against you. Now, there are some out there that do still have July cuts or September cuts, so it might take a little bit of while for that to work out, assuming that we don't see the first cut towards the end of the year. Right now, the market's got about 45 basis points of rate cuts priced in this year. So from our perspective, we actually in the near term are heading towards a little bit of a richer end of the range, which just accentuates for us. We are in this higher rate range type trading environment, looking at a pretty neutral two-way, but without seeing still that cyclical bull steepening trend that we are expecting. We were originally expecting to take hold just about around this time period when we were looking out, perhaps say in November. Given just the lack of progress in disinflation, we're similarly pushing that out along with the rate cuts. So we think that that's probably going to be more probably in towards the end of the year with that first cut in December, knowing you have the elections in the meantime. You have that hurdle that risk taking is going to be light. The markets are probably going to be reluctant to necessarily really push a lot forward before that. I will say though, on curve, we actually have a little bit more confidence towards a general steepening trend. You could take a similar range trade environment when you look at curve, but as you think about going into the elections, depending on how polls are going to go, the potential for government sweep on either side, currently more likely for under a Republican administration, is could bring in fears of potential steepening trades off of that, given the Trump's desire to extend all the trade tax cuts, the trade environment on its own with potential tariffs, which is kind of stagflationary kind of outlook. A lot of the policies that we've written about and discussed point towards potential steeper curves, and we currently put maybe a 20-25% probability on that. Maybe not today's trade in May, but as you go through the summer and election season starts to look closer and closer, you could see the market start to handicap the risk of that happening. So even though we're talking about higher for longer and rate ranges, probably oversimplifying things, one cut to two cuts priced in the market, 25 to 50 basis point when it comes to Fed pricing, and then expand that out the curve. But I do think that for first time in a while, just really starting to look at more of a, buy dips on the steepener side of things, but more tactically neutral on duration and just playing this higher rate range.
You talked a lot, of course, about how, important the monetary policy view is in driving your rate view. But there's a lot of nuance within the kind of global monetary policy cycle in terms of policy divergence. What are you looking at there when it comes to yield spreads?
Yeah, and I think you're really hitting on something that's increasingly coming up, not just within rate discussions, but FX and how, and you even see in the press conference or in the headlines today out of Bailey saying there's no rule, the Fed has to go first. So, there's a lot of thought around in the whole, media sphere, investor sphere about, okay, so if the Fed's pushed off, what does that mean for other central banks? And we're looking at it really those more closely tied to the Fed's wake, maybe a Bank of Canada is obviously going to be more impacted. Others, we believe, like when it comes to Bank of England and ECB, should be less hooked into. But even in other central banks globally, can they still cut? Yeah. If the answer is yes, will they cut as much? Perhaps no, perhaps yes. So a lot of monetary policy divergence questions happening across the board. When I think about just putting my U.S. Treasury rate strategist hat back on, if you look at things like, Europe's been pretty clear about cutting in June. So the Bund U.S. spreads are at the widest they've seen since 2019, just using 10 years as a benchmark. When you look at gilts, it's kind of in the middle of that multi-year range. So I do think, supply concerns noted with the UK. I do think, though, that if we really don't have 10-year yields moving lower towards 4% towards the end of the year, and granted, I think that there's not enough term premium in the markets for higher inflationary potential election impact environments anyway. Structurally, curves, I think, are a little too flat still in the US, just from a multi-year perspective. But, if we have 10-year notes ending at 435 by the end of the year in the US, and they're currently at 450, I think all the action is going to be in the front end once the rally does happen. That US UK spread, I think, does have some room to move out, perhaps further in the long end. So, I do think that as you look at a higher rate range and we digest all your comments from today, we digest the results of the Bank of England meeting, is it June or July? I think the more emphatic point of the market over the course of the cycle, whether you're looking through 24 or early 25 in the UK, is probably not pricing in enough. I think in the US, the market will be pretty reluctant to price in more until we get closer to that first cut. I think the act of cutting in the UK could start to spark perhaps more movement around that. And as we get closer to that, whether it is June, whether it's August, so there might be more action here actually across market spreads for a while. From a U.S. Treasury perspective. So I do think that that's something people should look at as we head into the summer and as we kind of hone in on when the BOE might start to go.
Yeah, I mean, that's completely in line with what we've been thinking as well. Certainly sitting on the UK side, it's felt a little bit frustrating at times this year, just how much UK rate pricing has been driven by the US. And like you say, you referenced Bailey's comments today that there's no rule that the Fed had to go first. And that was kind of in response to a question in the press conference of, is it a bit frustrating? Everyone thinks that the UK just has to follow the Fed. And I do actually think the ECB going, although it's been very clearly telegraphed and the market's, pretty perfectly pricing this in, the ECB going in June ahead of the Fed, we think, should give should highlight this idea that actually the Fed doesn't have to go first, and that could be a bit of a trigger for decoupling of rate spreads in the UK as well. Which probably brings me nicely onto you, Joann. The Euro area has been a little bit on the back burner, I think, this week with everything that's going on in the UK. But we have had some ECB speak. Have we learned anything new from them?
Yeah, so as you said, Imogen, a fairly quiet week in Europe, all things considered. But I think what was really interesting to me was comments from the ECB's lunch. To me, it seems like even the hawks in the committees are starting to shape shift to some extent to doves as well, with one usually hawkish member saying that he did think that at this point the risks were towards inflation undershooting versus overshooting the target. So I do think it really speaks to how much or how far we've come in terms of the European inflation story. Well, that moderation has really been key in driving the ECB's narrative for a June cut. and the Hawks kind of joining alongside that narrative and even tilting a bit dovish. We obviously saw Bill Wah, who's usually a neutral member in the last few weeks, note that he thought that a cut every meeting from June would be likely. But I think that overall, I think there's been a bit of a dovish shift to me in terms of the ECB committee and their decision making for this period forward. So with that being said, of course, June remains the first or the base case for a cut. And I suppose the path from then onwards is obviously a bit murky. The ECB also gets asked quite a lot about the Fed and the impact of the Fed on their reaction function. As we've said before on this podcast, we don't really think that it impacts the timing of cuts. But of course, a Fed that's not cutting or cutting only by a little bit, so 25 at the end of this year as our base case, could moderate the amount of cuts we get. So we've had this range of 75 to 100, but in the path where the Fed doesn't cut and only cut at the end of the year, we would be at the lower end of that range, and which is essentially in line with market pricing for now. But Layden makes some interesting points on this divergence story and the impact on the exchange rate. He specifically noted that even though there are exchange rate impacts from ECB perhaps going before the Fed, interestingly enough, he did note that actually in terms of the rates markets, which tends to correlate quite highly with the Fed, that perhaps the impact on rates will be as well for higher rates in the euro area that can offset to some extent that question of how much will the euro USD depreciate if the ECB does deviate a little bit. So I mean, I think there's a lot to consider. I think the forecasts are due an update in June, and lots has changed since then. So I think it's a wait and see for now for the June meeting, the forecast update, and obviously the data that comes out before then.
The other thing that we've been watching closely this week, especially with one eye, as always, on this kind of supply narrative in rates markets, has been the take up in the BTP Valore, which is Italy's retail funding instrument that was introduced over the last couple of years. Historically, and we've discussed it on this pod, but one of the reasons why we've been more positive Italy, for example, than France, despite not great supply dynamics in each, is that Italy has been able to offset some of the call on the capital market by relying quite heavily and quite successfully on the retail market to absorb some of these increased funding needs. What's the take up been like this week, and how has that changed how you're thinking about Italian funding and what that might mean for BTP spreads for the rest of the year?
We were fairly positive on the retail picture for Italy before this week, just because I think there's still quite a lot of cash left overnight in Italian household deposits, which could in theory be recycled and used to buy this BTP Valore or retail bond or Italian debt in general. So I think to me it was quite surprising that the take-up was quite weak. We had initially penciled in around 18 billion of funding for this week, but it looks like that might be more 10 to 12 billion based on what we're seeing coming out what we have seen coming out over the last few days. So a pretty big downside surprise versus our initial expectations. I guess it could be driven by a number of factors. So firstly, I think there was quite a lot of marketing in March that the government was doing around the BTP Valore that helped to drum up this excitement and actually mean that the March Valore was the largest Valore issuance we've seen over the last since the Valore was really issued. There's obviously been no competition now, we think, in terms of current account deposits of offering higher rates than they were previously. So the banking sector is starting to pick up and offer better rates, which might have deterred customers. I think that the last thing is more of a psychological element, I suppose, where this BTP Valore, even though the gross effective yield to maturity was higher than the March Valore by quite a small amount, it didn't actually have that psychological 4% coupon at the end at the last few years, which the previous Valore did have. So it might have also been played a part to some extent. But I think overall, I think it probably does mean that our initial forecast of 50 billion of gross retail funding for this year for Italy is now going to be revised lower to 40 billion. We do think we could see one more retail issuance or retail specific issuance to come this year, which could raise around 10 billion. So I think 40 billion would be a better estimate for retail funding for this year versus 50 that we had previously. So I think in conclusion, what that means is we obviously would have to see some more of that cash raised from the capital market. So a 10 million increase versus our initial forecast of what the Tesoro would have to raise from the capital market. So I do think it's problematic, but I think the positive side of the story is that they still have raised quite a lot in relative terms, relative to other countries in terms of their retail funding. And if they do get 40 versus 50, that's still 40 more than other countries have had in terms of retail demand. So I think at the margin it is mildly negative for BTP spreads. But I think what I've said before still holds in the sense that it's a bit difficult to be negative spreads or BTPs versus Germany, for example, going into a rate cutting cycle. And we do think that the overall atmosphere for spreads is different now, just because there seems to be more EU unity. Politics is not really an issue in Italy either. Rate cuts mean that the average funding cost will come down versus this year. I do think that overall, rate cuts will play positively for periphery spreads. So, I think mildly negative, but overall, I still retain the positivity towards spreads going into the cutting cycle.
Great, thank you. All right, let's wrap it up there for this week. Thank you both for joining me. Just a reminder to our listeners, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episode as soon as they're available. Thanks, see you next week.